This is Jessica Dunn. We're going to continue our discussion on capital budgeting, but talk about projects with unequal lifespans. So if we have projects with unequal lifespans, we need to make some modifications. So here's an example. We have a short project that costs $100 and returns $60 for 2 years. We have a long project that costs $100 and returns $33,500 for 4 years. These projects are mutually exclusive, but they do have unequal lives. The cost of capital is 10%. So if we were to calculate the net present value of the two projects, we would see that the long project is better as stated. But is it really better? Because we're not making an apples to apples comparison. We're making a comparison on two projects that are drastically different. So even though the net present value is stated higher, we need to make sure that that is actually true. So if we're looking at projects with drastically different lifespans, we can use the equivalent annual annuity approach. We convert the present value into a stream of annuity payments with the same present value. So with short, we would say that N is 2, so this is short. Our discount rate is 10%, that was given to us. The present value is that we calculated as our net present value, so 4.132. Again, this is in thousands. And our future value is 0. So we can solve for payment. Our payment would be our equivalent annual annuity. We do the same thing for long. Here we have a 4-year project though. Same discount rate, our cost of capital is the same. The present value is 6.19. Future value is 0. And we solve for payment, which is our equivalent annual annuity. Now, one thing we need to make certain of here is that, remember, either your present value or your future value has to be negative. So I'm just going to put in a negative sign here for our present values, so that way we'll get a positive equivalent annual annuity. Again, it's for interpretation, so it doesn't matter a great deal which you solve as negative, just so that you recognize that's the way your calculator works. So first step, I'm going to clear my time value of money. We have 2 years, 10% discount rate. We have 4.132 as our present value. Our future value is 0, and I'm going to compute the payment. And I get 2.38, so $2.38. Again, that's in thousands. Same thing for project long. So here we have a 4-year project. Discount rate was the same. Present value is 6.19. Need to put that as a negative. And our future value is 0, so I'm going to compute the payment, and we get 1.95. So when looking at this, we see that shorts was 2.38 and longs was 1.95. So the short project has a higher equivalent annual annuity than project long, so it's actually the better project. So we would choose project short rather than project long. Another way to do this is to put the projects on a common basis. So let's see, we could consider project short, but repeat it after 2 years. So that way we can put them on the same lifespan. So project long was for 4 years, project 2 was for 2 years, but if we do it twice, then that'll give us 4 years to make a comparison. Equivalent annual annuity is the alternative to this approach. So if we're going to replace the project after 1 year or after 2 years, so that way we can start it again and have a project with a lifespan of 4 years. Then in time period 0, we're going to invest $100, return $60 for 2 years. But in the second year, we're going to spend another $100 and have returns for another $60 for the final 2 years. If we take the net present value of these resulting cash flows, then we get a net present value of 7.55, which is greater than the net present value for large. So that again shows us that short is better. Now you may assume that after 2 years the cost increases. So you don't have to assume that the cost is going to stay the same. So here we're saying the cost was 100,000 today, return 60,000. In 2 years it goes up to 105,000 and we return 60,000. Calculate the cash flows from the resulting calculations and use that to calculate net present value. And we get a net present value of 3.415. Now we see that project large is actually better because it has a higher net present value than project short. So it depends upon the cost of reinvestment. What about economic versus physical life? So just because you purchased something that will last 20 years doesn't mean you have to keep it for 20 years. So should you always operate for the full physical life? So here let's consider an example. So we purchased an item that cost $5,000, and at the time we purchased it, it's still worth $5,000. At year 1, we paid $5,000 for it, and we've gotten $2,100 in earnings from it, and we could sell it for $3,100. In year 2, we paid $5,000. We received $2,100 the first year. We received $2,000 the second year, and we could return it or sell it to someone else for $2,000. This asset only has a 3-year life, so at the end of the 3rd year, it would have no remaining salvage value. So should we keep it for its full physical life, or should we sell it while it still has value? So if we were to look at not terminating the project, then we would spend $5,000. It would return us $2,100 the first year, $2,000 the second year, and $1,750 the 3rd year. That would give us a net present value of a negative $123. So it wouldn't be a good idea. The second option was to terminate after 2 years. And we see if we were to terminate after 2 years, we would pay $5,000 for the investment. We would receive $2,100 the first year. The second year we would receive $2,000 and we'd sell it for $2,000. So that gives us a $4,000 cash flow in year 2. That net present value is $215, so it's positive. So this makes the project feasible. If we were to terminate after just 1 year, we would still have a negative net present value, so it would not be a good idea. So this project is only acceptable if it's operated for 2 years. Just because a project is physically able to operate for multiple years doesn't mean that it should. So finance theory says that we should accept all positive net present value projects. There can be several problems when we don't have enough internally generated cash. We could face capital rationing, and we can face an increased cost of capital. So we exhaust all of our cheap funding, want to raise additional capital, and that comes at a higher rate. Our increasing marginal capital, this is where externally raised capital has large flotation costs, which can increase the cost of capital. Investors often perceive large capital budgets as risky, which will also drive up the cost of capital. And if external funds are being raised, then the net present value of all projects should be estimated using that higher cost of capital, not the previous cost of capital. So we're always looking at our next dollar cost, so our marginal cost of capital. Capital rationing occurs when a company cannot fund all positive net present value projects. The company will typically set an upper limit on the amount of capital that they can make during a period and only accept the best projects.